Good day everyone, we are from Group 6 and today our group will be presenting about how neoclassical economics extended the economic analysis of discussing on imperfect competition as well as the monetary economics which is based on chapter 16 and chapter 17. These are the members of Group 6.
My name is Kok Shipei and my matrix number is 296217. And now let's start with the introduction. The neoclassical school did not have 5 major questions. However, there are differences between the earlier marginalist and later neoclassical economists, such as value theory, monetary economics, and the imperfect competition that Kat refers to. Next slide. In this assignment, we will discuss the second and the third differences, which is monetary economics by WICKSELL and Fischl, and the imperfect competitions by CHAMBERLIN and John Robinson. For the differences between the earlier marginalist and later neoclassical economics, first of it is a value theory which neoclassical economics stress both demand and supply in determining the market prices of goods, services and resources, while the marginalist stress demand alone and classical stress on supply alone. The second one is monetary economics, in which several of the neoclassical economists such as WICKSELL and Fischl took a far greater interest in the role of money in the economy than the earlier marginalists. Lastly is the imperfect competitions, while neoclassical economics extended marginal analysis to market structure other than pure competitions, pure monopoly, and duopoly. There is no separate school of monetary economics as such. Although some contemporary economics are called monetarists, the classical and Marxist school and the early marginalists regarded money merely as a veil that has to be pulled aside to examine the real world. They felt that money and prices are subordinate to more basic economic factors. Others, such as WICKSELL and KNUT, combine the monetary analysis with their studies of fundamental economic process. Money in economic theory was destined to increase in importance over the years with the growth of banking, credit, and economic fluctuations, as well as the increasingly important monetary policies of central banks and governments. WICKSELL and Fischl made a twofold contributions to economics. First, they explored an area that had been neglected but was growing in importance and therefore required emphasis. Second, they helped integrate monetary analysis into general economic theory. It is important to note, however, that they may have exaggerated the role of money. It is easy to overcompensate for past shortcomings by allowing the pendulum to swing too far in the opposite direction. So, even though certain aspects of these theories presented by WICKSELL and Fischl are more closely associated with macroeconomics than microeconomics, these economics are within the overall Marshallian neoclassical tradition. Monetary branch aggregated these categories for the whole economic, emphasizing the monetary factors along with real factors. It remained for the later economics to synthesize monetary and non-monetary economics, although credit is still WICKSELL as an important forerunner of these later economics. This part will focus on the contributions of WICKSELL and Fischl as monetary economics in neoclassical school. John Gustav KNUT WICKSELL was born in Stockholm, Sweden, in a middle-class family. After studying mathematics, languages, literature, and philosophy as an undergraduate at the University of Uppsala, he took advanced degrees in mathematics and physics there. He was elected president of the student body of the university and became increasingly active in the philosophical, political, and literary debates and activities of student circles. He was both a scholar and social reformer, two pursuits that in his days were often considered incompatible. WICKSELL's interest in social problems and reform led him to a study of economics. From 1885 to 1890, he studied at universities in England, France, Germany, and Austria. His most memorable experience in the studies of economic theories was his discovery in a Berlin bookshop of a book on capital theory soon after its publications in 1888. This book had a profound influence on his own economic thinking. WICKSELL made several major contributions to economics. For example, he was one of the earliest economists to suggest that the typical firm will first experience increasing returns, then constant returns, and finally decreasing returns as it expands its size. WICKSELL anticipated the theory of monopolistic competitions that was worked out later by Chamberlin and Robinson in the 1930s. In addition, his work became one of the sources of Keynesian economics. Keynes himself complimented WICKSELL as an important precursor of his own ideas. WICKSELL's overall objective was to synthesize monetary theory, business cycle theory, public finance, and price theory into one system. Although he was not totally successful, he advanced the state of economic thinking in this area. WICKSELL's chief claim to fame lies in his contributions to monetary economics. These advancements include an analysis of the roles of interest rate in achieving an equilibrium price level or in generating cumulative inflationary or deflationary movements. Recognition of the potential contributions of the governments and central banks in retarding or promoting price stability, and an early statement of the saving investment approach to macroeconomic equilibrium. This last contribution established WICKSELL as a father of the so-called Stockholm School of Economics. There was questions to WICKSELL that why do prices collectively rise or fall? To answer these questions, WICKSELL turned to an analysis of interest rates. He distinguished between the normal or natural rate of interest and the bank rate. The normal or natural rate of interest, he says, depends on supply and demand for real capital that is not yet invested. The supply of capital flows from those who postpone consuming part of their income and thereby accumulate wealth. The demand for capital depends on the profits that can be realized from its use or its marginal productivity. The interactions of supply and demand determines the natural rate interest rate. The concept of natural or normal rates of interest is determined by the balance between the demand for loan capital and the supply of savings. When economic prospects improve, demand for capital increases initially exceeding supply, causing the interest rate to rise. The rise in rates encourages further savings and eventually leads to a new equilibrium at a slightly higher interest rate. This equilibrium also extends to the market of goods and services where wages and prices remain unchanged. However, the excess income generated from savings and investment doesn't create immediate demand for goods but rather supports a future production through labor and land investment. The normal or natural rate of interest applies only to credit between individuals. Banks, however, complicated matters because unlike private persons, they are not restricted to their own funds in their lending or even to the funds placed at their disposal by savers. Because banks create credit, they can extend loans even at very low rates of interest. On the other hand, they need not lend out all of the funds placed at their disposal by savers. Hence, the bank rates of interest may be either less than or greater than the normal or natural rate of interest. When either of these two situations occurs, the price level will eventually change. The first is bank rates less than natural rates. If bank lends money at lower rates than the natural rates as defined in the previous quotations, saving will be discouraged and the demand for consumption goods and services will rise. Simultaneously, entrepreneurs will seek more capital investment because the greater net profits to be realized as the cost of borrowing money falls. As investment increases, more income accrues to workers, landowners, the owners of raw materials, and so forth. The prices of consumption goods therefore begin to rise. Juxtaposed with this increased demand for both consumption and investment goods, however, is an unchanged or even diminished supply of goods as savings diminish, assuming that we start at the positions of full employment. Anticipations of price increases will cause price to rise even more. Equilibrium is disturbed, and the cumulative upward price movement begins. The fundamental cause is a bank or market rate of interest below the natural rate that would bring into balance real saving and real investment at constant price. Prices will rise without limit so long as the bank rate of interest is less than the natural rate. The second situation is that the bank rate is greater than the natural rate. Conversely, if the bank rate of interest is above the natural rate, prices will fall. It is because saving will increase and thus investment spending will decline. The decline in investment spending will reduce the national income, which in turn will cause the prices of consumer goods to decline. With the price of both capital and consumer goods falling, the general price level will obviously decline. That is, deflation will occur. Expecting further price declines, buyers will reduce their present expenditures even further, thus get at the deflation.
Good morning, sir. My name is Yong Hui Fa. Next, I'm going to present the implication for public policy on monetary economics. WICKSELL analysis of interest rate and he preferred for highlighted the role of government central bank in promoting economic stability. Interest and price published in 1898 became the first economist to educate the stability wholesale price by controlling discount and interest rate. He also said that the main reason cyclical fluctuation was technology and commercial progress had not maintained the same advance as the increase, especially expanding population when demand increased. People try to take advantage of the situation by increased investment because it took time to increase output level to new discovery. WICKSELL also focused on monetary cost. To eliminate the monetary cost, he advocated that bank exhibits a lag that equal to natural lag, while latest interest lag is the lag that meant by the supply and demand where money does not exist, and the natural lag interest lag is not in fact itself. It caused by the natural lag fluctuated with the real economic factors such as production efficiency and capital supply.
Next, WICKSELL also concerned the growing production and stock of gold affect the currency, thus cause the inflation interest rate to fall and the price increase. He also indicated that we need to use the international paper currency standard instead the gold coin to avoid the currency of gold collapse. In this good, he also said that the regulation of price will constitute first purpose of the bank rate and the bank rate would be perfectly free to move, and government by this deregulate arms of the bank. Next, I'm going to present for saving in monetary economics. Jeremy Bentham has issued a doctrine called forces frugality in Manual of Political Economy and published in 1843. According to Bentham, tax and bank loan has been forced to save from increased government capital such as indirect tax, while John Stuart Mill on profit and interest in the essay on some unsettled question of political economy written in 1830. Both economists discuss the tax and income. In addition, Lord Wallace Early has started the theory of forced saving in 1879. This probably inspired WICKSELL to analyze this theory. WICKSELL has made an example of a new class enterprise financed through full creditation for forced saving theory. He said that the assumption for this example, which is through full employment at the outset. Next, more land and labor will be employed in the process of capital goods. The new enterprise has less credit available for turning up consumption goods, which is no credit to finance. The demand of consumption will also greatly increase as the entrepreneur will increase the price of land and labor as their investment increase. As the price increase, fewer capital goods will be produced, thus restricting consumption. This restriction will constitute the real accumulation of capital, so the real saving which is necessary for the period of investment to be increased is enforced. Next, I'm going to present WICKSELL on imperfect competition. In 1901, WICKSELL wrote the retailers usually have a fixed circle of customers and enable them to have fixed rather than fluctuating price, while retail price to respond to change in wholesale, they do also only after a time lag and in modified form. Next, I will present about the Irving Fisher. Irving Fisher is an American economist who was born on 27 February 1867 in New York. He is also a statistician, which is from a young mathematician turned to economist. He also progressive in social campaign. He joined anti-tobacco crusade supporting campaign against alcohol and tobacco. Irving Fisher is also an inventor that created many mechanical gadgets. Last is about the Irving Fisher health and diet. He suffered from tuberculosis in his youth, which led him to explore a popular book on health. Next is about the Irving Fisher publication. There are some books most popular such as The Rate of Interest, The Purchasing Power of Monetary, and The Theory of Interest, and the others. Next, I will present Fisher theory that divides into three parts, which is theory of interest, the quantitative theory of money, and monetary policy. First is the theory of interest. In his The Rate of Interest, published in 1960, Fisher set forth his sophisticated theory of how interest rates are determined. He published a revised and expanded version of this theory in 1930 in his The Theory of Interest. Fisher perceived two factors interacting to establish the interest rate, which is the inflation rate and the investment opportunity rate. The inflation rate is the extent of the community willingness to obtain present consumption income by giving up future consumption. The amount of future consumption it is willing to trade off for present consumption depends on how impatient is it. For example, the less impatient, the more it is willing to save and invest, thereby gaining future consumption. The more impatient, the less it is willing to give up present consumption to save in order to obtain goods in the future. This is when society have much present consumption relative to future consumption. The relative value of additional amount of present consumption is small. The second factor in interest rate determination, said Fisher, is the investment opportunity rate. At one extreme, it would be feasible to devote these resources to producing goods for present consumption alone. At the other extreme, society could use all of the produced capital such that present consumption was zero but future consumption would be large. However, as society moved from this first extreme, all present consumption to the latter no present consumption, it experiences diminishing marginal return. That is, as people cut back the present consumption to increase investment and thereby to obtain greater future consumptions, the lack of return on investment will fall. The Fisher word, the more we invest and postpone our gratification, the lower the investment opportunity let become, but the greater the impatient let. The more we spend and hasten our gratification, the lower the impatient let become, but the higher the opportunity let. The less we save and invest as a society, the lower is relative value of present consumptions and the higher is the marginal let of return on investment. The equilibrium interest let will occur where the lack of return on investment and the lack of society is willing to trade off present for future consumptions are equal. We see then that the interest rate depend on both the technological ability of society to gain greater future consumptions by giving up present consumption and society willingness to trade present for future consumptions. The lack of interest, which normally will be positive, will exactly reflect the premium people are willing to pay for present rather than future consumption. Some individuals will decide that it is then best interest to lend money, postpone consumption at this interest rate, whereas others will decide to borrow money, consume how later than later. Furthermore, saving will just equal investment. Fisher pointed out that the real rate of interest may not equal that observed monetarily of nominal interest rate. The latter depend upon the expected rate of inflation. For example, the expected rate of inflation is 5% and the real rate of interest is 3%, then the nominal rate of interest will be approximately 8%. Lender will demand X% to ensure that borrower return to them the full purchasing power of the principal lent out plus the real interest rate. The effect of inflation on the nominal rate of interest has come to be known as the Fisher effect. A rapid increase in the stock of money may initially reduce interest rate, but according to Fisher, it will also cause price to rise. Lender will increase the nominal rate of interest by an amount equal to the rate of inflation expected over the life of their loans. Higher nominal interest rate may be caused by the high expected rate of inflation as opposed to real factors such as time preference and real rate of return on investment.
Assalamualaikum, my name is Muhammad Nazim Barazam. My matching number is 28564. I'm continue to the quantity of theory of money. The quantity of theory of money have five determinants of the purchasing power of the money, or is inverse the price of labor. So the first one is the volume of currency in circulation. Second is the velocity of circulation. Third is the volume of bank deposit subject to check. And the fourth is velocity, and the last one, fifth, the volume of trade. So I will to continue. The next is the Fisher equation of exchange. The equation is mv plus m prime v prime equal to pt. M is the quantity of currency, v is the velocity of circulation, m prime is the quantity of demand deposits, v prime is the velocity of circulation, p the average level of price, and t is the quantity of goods and service transits of sold, with each units being concerned each time is sold or resold. According to the Fisher, price vary directly with the quantity money m and m prime, and the velocity of the circulation v and v prime. The price is vary inversely with the volume of trade t. The volume of demand deposit m prime tend to hold a fixed relationship to the quantity of currency in circulation m. That is, deposit are normally a relative fixed definition material currency. So we continue to the cause and effect relationship between the quantity of current and the price levels. Fisher assumed that the velocity or circulation and the volume of trade are constant. The tendency towards stability is T also depend on full employment equilibrium. This is because with considerable unemployment, an increase in M might very well increase T instead of P. After that, in the long run, the volume of trade also grow with the change in the population, efficiency of production, and so forth. In the short run, with a full employment economy, the quantity of current in circulation normally determine the price level. Okay, we move to the next slide. What is the transmission mechanism draw which increase or decrease in M cost change in P? Firstly, people decrease to hold a specific quantity of cash balance in relationship to their expenditure. So people choose to hold their money to balance their relationship between the capital expenditure, so they can spend more to the expenditure such as the service and goods. Second is the increase in the amount of cash in economy distribute this optimal ratio, causing individuals to adjust their cash to expenditure ratio by increase the expenditure. We move to the next point. According to the Fisher, there is a direct link between increased currency and price. That means currency and price have positive relationship. For example, when the currency is increased, the price also increase. Next is the WICKSELL had stress and directly link. Money creation will cause change in the bank interest rate that will set off change in saving and investment that would eventually cause the price to change. Okay, we move to the next slide. Is the monetary policy. Monetary Fisher say the quantitative theory of money offer a way to stabilize the overall price level and theoretically stabilize the economy. Fisher plan is about gold coins. Use only gold certificate paper money recommended in the gold billion. So Fisher want use the gold billion paper money. Don't use any more coin gold. After that, Fisher believe that price fluctuation costs rather than result from business fluctuations. Therefore, stabilized price by controlling the quantity of money will eliminate the business cycle. We move to the next point. Is after crash of 1929, Fisher saw the greatest cause of deflation and depression as the growth of debt. Why crash of 1929 occur is four. First is the bank failures during the Great Depression. Second, cause of bank failures. Third is the impact of bank failures on business and individuals. And the last one is government response to the bank failures. Next is Fisher belief that fluctuation in demand deposit are the greatest cause of business fluctuation. Next, we move to the next point. Is Fisher's solution was to require 100% reserve behind demand deposit, thereby devoting the process of creating and destroying money from the business of banking. Have three solutions from Fisher. First solution is buy liquid bank asset up to 100% of the checking deposit. Second is bank could lend out only their own money for the money put into the saving account. And the third and the last one is bank will have to levy service change or deficit to compensate themselves for their loss of earnings. From monetary policy from Fisher have biggest benefit for the economy world. The biggest benefit of Fisher policy will be the elimination of great monetary inflation and deflation. Using monetary policy from Fisher, we can avoid and manage the deflation and inflation in economy. Second, to stabilize the purchasing power of the dollar, the currency commission will be required to buy security when the index was below the official par to sell when it was above. It is apparent that the Fisher did think the business cycle are inherent in economy. So in business and economy, business cycle is important to see the improvement in economy if it grow or it down. Last part for monetary policy for Fisher is Fisher did outstanding work in mathematics, economy, statistics and index number. Fisher was pioneer in developing the new field econometrics, which made a statistical method as a part of economic analysis. And the last one, Fisher was honored for the contribution by being elected for president of the American Economic Association, the American Statistic Association, and the last one, the Econometric Society.
Okay, thank you to the presenter. So I will continue the presentation. First, let me introduce myself first. My name is Amira Idaham and my metric number is 289615. So, I will talk about the neoclassical school, which is the pure competition. Which is it developed by the KNUT model as early 1838 with the HASTINGS and WICKSELL analyze situation in which demand curve faced by the competitors were less than and perfectly elastic. So we will continue to this picture, which is it's explained about the market structure. It was divided by 3, which is a perfect competition, monopoly, and imperfect competition. So in imperfect competition, we will divide by 2, which is oligopoly and monopolistic competition. So as you can see in this table, which is the characteristic of the 4 basic market model, which is a pure competition, and also we know the perfect competition and monopolistic competition, oligopoly and monopoly. First, we talk about the number of firms. For pure competition, it was a very large number, but for the monopolistic competition, it also many. Oligopoly few and monopoly just once. Okay, types of product. For pure competition, it was standardized, which is all firm can sell it. For monopolistic competition, is differentiated, and the oligopoly is standardized and or differentiated. And for monopoly is unique and no close-ups, which is nobody can copy their products. So next is control over price. For pure competition, it's none. So many firms can sell the product at with a different price. For monopolistic competition, some but within rather narrow limits. And oligopoly limited by mutual interdependence considerable with collision, and monopoly is considerable, which is it depend on the situation. So when the inflation happen, the price maybe will increase, maybe will decrease, so that can help people, and it also can increase. Condition of entry for pure competition is very easy and no obstacle, which is many firms can join this pure competition for many firms. Monopolistic competition, which is relatively easy. Oligopoly, significant obstacle, and monopoly is blocked. It was because the cost for this firm is very high. Okay. Non-price competition. For pure competition is none. Monopolistic competition is considerable emphasis on advertising brand names and trademarks. Typically, a great deal particular with product differentiation. For monopoly is mostly public relation advertising. So example for pure competition is agriculture, and monopolistic competition is retail trade, dresser and shoes, which is like Puma, Adidas. So for oligopoly, steel, auto, farm and implements, which is more for the cars and others. Monopolistic is local utilities, which is like TNB, like water. So, in conclusion, Chamberlin and Robinson focus on scenario between pure competition and pure monopolistic highlights the complexity of real-world markets dynamic, offering a valuable insight into economic theory. So let's continue to the next slide. Okay, so let's continue the slide, which is monopolistic competition. First, let me introduce the figures for monopolistic competition, which is a Chamberlin. He born in LA Corner, Washington. He received his undergraduate degree from the University of Iowa, and he published the theory of monopolistic competition at 1933. So, in pure competition, this firm can sell all their product at the market price. This means marginal revenue equal to the price, and both the marginal revenue and demand curve are horizontal line. For example, if an entrepreneur can sell one pair of shoes per day at a price of $20 for 2 pairs at $18 and 3 pair at $16. In each case except the first, the marginal revenue is less than the price. I know you still confused, so we move to the graph. As you can see, in this graph, it's given demand curve for D and marginal revenue curve MR, and the monopolistic competition quantity for B, at which MR equal to MC, and at which it's earn an economic profit of LM and S at this square. This economic profit attract this for a new entrant to the industry, resulting in a downward shift of the firm demand and marginal revenue curve to D and MRS. You can see the new demand is downward shift, and also for the MR demand. In long run equilibrium, the firm maximizes profit by producing a quantity of A, earns only a normal profit at P equal to AC. As you can see in this graph, produce less than the competitive output, and change a price R exceed marginal cost and lowest average cost. The result is excess capacity and allocative inefficiency. So, the conclusion, which is Chamberlin, are built on the unrealistic assumption that cost curve are the same in each situation. And number 2, contemporary economic note that a world of pure competition with all products being standardized would be a dull world indeed. So that's all from me. So I will give to the next presenter. Thank you.
Good morning, sir and everyone. My name is Chi Jiahui, metric number 292220. And now I will continue my part, which is on Joan Robinson and her view on monopsony in monopolistic competition. Joan Robinson, along with Edward Chamberlin and Heinrich von Stackelberg, is one of the notable people to develop ideas about situations in pure competition and monopoly. Now I will briefly introduce Joan Robinson. Joan Robinson is an important figure in the post-Keynesian tradition. She is known for her contributions to economic theory, particularly in the fields of Keynesian economics and imperfect competition. She is a longtime professor at Cambridge University and was a student of Alfred Marshall. Joan Robinson was known as a critic of conventional economics in her later years, and her overall works are difficult to fit in any particular school of thought. The most well-known publication is The Economics of Imperfect Competition, published in 1933. So in this book, Joan Robinson introduced the concept of imperfect competition, which challenges the traditional assumption of perfect competition in classical economics. She believes that many real-world markets are categorized by imperfect competition, where firms have some degree of market power to influence price. These are her other publications. So her contributions in economic study include Keynesian economics, where she played a key role in extending Keynesian economics, and also post-Keynesian economics, where her work helped shape the post-Keynesian school of thought that emphasizes the role of effective demand and the limitations of neoclassical economics. Other contributions from Joan Robinson's are in the field of economic development and also international trade. She also offered critiques on the Marxist economics. Moving on to the next slide, Robinson added the concept of monopsony into monopolistic competition. Monopsony is a situation in which there is either a single buyer in the market or a group of buyers acting as one. From monopsony, Robinson analyzed the outcome of monopsony buying power in terms of product and also resource market. In the concept of product market monopsony is that when there are many buyers of a commodity, aggregate demand curve slopes downward and to the right, which is based on marginal utility. So this means that the more units of good received, marginal utility will decrease as stated in the law of diminishing utility. So in the product market monopsony, we assume that the market demand curve remains unaltered and the supply curve remains unchanged when there is only a single buyer or if all the buyers form an agreement to act together. This is because this indicates how much all the sellers together will offer at each price. In a monopsony situation, supply price remains unaffected as it is only based on production cost of each quantity. There are two generalizations stated by Robinson on pure competition and monopsony. In pure competition, buyers will purchase goods continuously at a time until price is equal to marginal utility, while in monopsony, buyers will adjust the purchases so that marginal cost is equal to marginal utility. So I will explain this part using a table. So moving on to the next slide, we can see that for part A, we are going to discuss about pure competition among buyers. So in this situation, we assume that market price of the product is $4 and no buyers can influence the price despite of the amounts purchased. So we assume that MU at the column of 5 is the marginal utility for a particular consumer who buys only this good. So buying the first unit of product will give the consumer $7 of marginal utility. Second unit of the product will give the consumer $6 of marginal utility, and so on. So at the market price of $4, the consumer will gain $4 of marginal utility. So in this situation, we can see that in pure competition, buyers will buy 4 units of product to match with the $4 of marginal utility, and it means that P equals to MU. So in part B, we'll look at monopsony situation. So assume that the same consumer is the only buyer for this product X, in this market. So buying the unit of 1 to 4 will give the consumer a marginal utility from $7 down to $4. So this is where the consumer will stop his purchase. So assume that firms can increase production of this product, but only if the cost increase. So this means that the more units that he wish to buy, the higher the price he will pay. So if monopsony wants to buy a larger number of units, he must pay a higher price per unit, as the bigger the output is, the higher the production cost per unit will be. So we can see this on the table based on column 1 and column 2, where the buyer will buy the first unit of X for $1, but the second unit will cost him $2 each, which is total cost of $4. So based on column 4, marginal cost of the second unit is $3, not the actual price of the second unit, which is $2. So as marginal cost is less than marginal utility, the buyer will continue to purchase. So we can conclude from this that the buyer will purchase 3 units of the product because MC equals the MU. Based on the explanation, we can see that monopolists will purchase fewer units of product than competitive buyers and will pay a lower than competitive price when the product supply curve is upward sloping. Monopolists can control the product price by adjusting the quantity of their purchase, just like the monopoly sellers can control the price by adjusting the level of output. So moving on, we are going to look at the resource market monopsony. Joan Robinson analyzed monopsony in the market for resources using the labor market as an illustration. We will disregard curve labeled VMP in the figure. Following Marshall's approach, Robinson declared that an employer's short-run labor demand curve is its marginal revenue product curve, which is MRP. So when there is pure competition, marginal revenue product MRP declines as more workers are hired because of law of diminishing returns. So this means that each added worker contributes less to the extra output, and therefore there will be less to marginal revenue than the previously added worker. So according to Robinson's theory of monopsony, market supply curve S is below the marginal wage cost curve MWC. So when firm wants to maximize its profit, firm will restrict hiring and pay wage below the competition. This means that we can see here in the graph that firm will employ workers to A instead of B and also pay wage on R instead of S. So the difference between the monopsony wage and marginal revenue product MRP is monopolistic exploitation and R. We can see here in the graph. So when there's monopoly or monopolistic competition in the product market, value of VMP, value of marginal product VMP exceeds market reference price MRP, and the monopoly exploitation is seen here as TN. Looking at the graph, in the case of monopsony, the labor supply curve slopes upward to the right because monopolist is the only employer on that particular type of labor. So this means that supply curve is equals to the average wage cost AWC. So when marginal wage cost MWC is greater than average wage cost AWC, monopolists must increase wage rates to draw in additional workers away from alternative employment, which means that maybe there are other firms that offer better wage and that the employee will switch firms. So the monopolists must increase wage rates to prevent that. So another factors is also includes household activity, leisure, and overall, monopolists have to increase wage rates to all of the workers. So at this point, extra cost of employing an additional worker will be more than the wage rate paid to the worker, because this includes the extra wage rates paid to the worker who could have been employed at a lower wage rate.
Hello everyone, my name is Pang Shuren and my metric number is 291652. So in this section, I'll be discussing about how many workers were the monopolists represented in figure 17-2 employ, meaning how many labor would the monopolists require during this figure. So the answer to my question is that the monopolists will employ the amount of workers at point A because this is the number at which the marginal revenue product of the last worker employed, which is MRP, will be equal to the marginal wage cost MWC at point N. If MRP is more than MWC, it will be profitable for the firm to hire more workers. And in contrast to that, if MRP is less than MWC, the firm could increase their profit by hiring less workers instead. The monopolist will pay the wage rate of L. This can be explained by the supply curve, where it can attract its profit maximizing number of employees, which is point A, at the wage rate of point L. We can be able to get three conclusions from this. The first conclusion is that labor market monopolists will employ less workers than employers in a perfect competition, point A rather than B, because they do this to keep the wages low. The second conclusion is that in this situation, workers are being exploited Exploitation means being employed at a wage that is less than one's marginal revenue product, which is R rather than N, because they're actually receiving less wage than they should have been receiving. So you guys might be asking, how about perfectly competitive labor market? So for the perfectly competitive labor market, employers can hire laborers needed at the market wage MWC of labor to the individual employer is equal to the wage rate, and when IRP is equal to the wage rate. Exploitation of labor does not occur in a perfectly competitive labor market. In this section, I'll be explaining about why the exploitation under the monopolistic market happen. So for the first point is that the sale of an additional unit of output does not add the full amount of the product price to the marginal revenue. To explain more into this point, in the monopolistic market, a seller has a lot of control over the price of their product due to lack of competition. So when a monopolistic firm decides to sell an additional unit of its product, it doesn't necessarily receive the full price of that product as additional revenue. This happens because in a monopolistic market, when a firm increases its sale of one unit, it must lower the price of all other units sold to stimulate the demand. As a result of this, the revenue gained from selling an additional unit, known as the marginal revenue, is less than the price of the product itself. Now I'll be moving to the second point, which states that the marginal revenue that a firm takes in when it hires an additional worker and sells the resulting greater output will be less than the extra output itself. So to explain more about this point, in a monopolistic market, when a company hires another worker and produces more stuff to sell, the extra money that they make from selling that product might not be as much as the extra product that they produce. This is because each new worker might not add as much value as the ones before. So, while the company benefits from the extra work, the worker might not get fully compensated for their contribution. Now, I'll be moving to the third point, which states that a firm will sell all units at a lower price, even though it could have sold at a higher price had it not hired the extra worker. This happens because in a monopolistic market, the firm has the power to set their prices. So when it hires an additional worker and produces more goods, it needs to sell them all to maximize the profit. So it sets a lower price to sell all the goods, even though it could have potentially have charged higher price for some of them if it hadn't increased their production. Now I'll be talking about a few remedies to counter exploitation. So the first is that the trade union should impose a minimum wage. So the minimum wage is to ensure workers receive fair compensation for their labor. The minimum wage also serves as a floor, preventing the wage from falling below a certain level. So thereby protecting workers from exploitation by employers who would unfairly pay them very low wages. When the supply of labor becomes perfectly elastic at the imposed minimum wage rate, it means that all available workers are willing to work at that wage. This reduces the risk of individual workers being forced to accept low wages due to a lack of alternative employment opportunities. When the marginal wage cost of labor is equal to the average wage cost, it indicates efficiency in labor allocation. Employers are hiring additional workers at a cost that is consistent with the average cost of all workers. This ensures that employers are not exploiting workers by paying lower wages to new hires compared to existing employees, as all workers are being compensated fairly relative to their contribution to the production. If the wage equals to the marginal revenue of product of labor, it implies that workers are being paid accordingly to the value that they add to the production process. This aligns wages with their contribution towards the production of the firm, ensuring that they are not being exploited by raising wages that are low compared to the revenue that they generate for the firm. The market must become perfectly or purely competitive to avoid the exploitation, even though it's actually quite hard to eliminate the monopolist's power in the market, but actually there's a few measures to help solve this issue. The first solution is that the policies aim at increasing market competition, such as antitrust regulations and measures to reduce barriers to entry, may possibly help to reduce the power of monopolists towards the market itself. This theory also has been criticized by a few people, so the first person is Chamberlin. Chamberlin says that all factors, not just labor, receive less than the value of their marginal product under conditions of monopolistic competition. Robinson's definition of exploitation applies only to pure competition in the sale of the product. According to Robinson, all the factors are exploited and employers could avoid the charge of exploitation only by going into bankruptcy. Robinson himself also stated that it's impossible under other market conditions for all factors to get the value of their marginal products because relevant data were not readily available and that the computational limitations would make it difficult to implement the right policies in a timely manner. Now I'll be concluding the whole chapter. The first conclusion is that there are actually two differences between the marginalists and the neoclassical economists in the economic analysis. The first difference is that several of the neoclassical economists took a far greater interest in the role of money in the economy than they did in the earlier marginalists. Second difference is that the neoclassical economists extended marginal analysis to the market structure other than pure accumulation, pure monopoly, and duopoly. The second conclusion is that WICKSELL has a few contributions to the monetary economics. Firstly, the analysis of the role of interest rate in achieving equilibrium price level or in generating cumulative inflationary or deflationary movements. Secondly, he recognized the potential contributions of the government and central banks in retarding or promoting price stability. Thirdly, he established an early statement of the saving investment approach to macroeconomic equilibrium. This established WICKSELL as the so-called father of the Stockholm School of Economics. Thirdly, Fisher also have a few contributions to the monetary economics. Firstly, the theory of interest. Secondly, the quantity theory of money. And thirdly, monetary policy are all contributions of him. Lastly, Chamberlin and Robinson also contributed to the theories of the imperfect competition. Chamberlin has contributed to the theory of monopolistic competition, and also Robinson have contributed to the theory of monopsony. While doing this slide, our group has referred to the book The Evolution of Economic Thought by Brew and Grant. These are some of the past year questions that is related to our topic.